Hi, it's the 26th of February and welcome to our tax update for this month, which will cover the local and international developments of February 2021. Let's have a closer look at these developments. A law was published recently in the Official Gazette amending the Central Agency of Equal Distribution of Burdens law, which imposes contribution on the sale of immovable property in the Republic. The proceeds will go towards supporting refugees and owners of inaccessible immovable property in an attempt to compensate for the inability to possess or use the land in the occupied North. Specifically, the law provides for a contribution of 0.4% on the sale of immovable property, as well as on the sale of shares in a company that owns immovable property, provided that the sale of shares results in the buyer taking control of the company. The contribution is payable by the seller of the property. An implementing guideline was recently issued, which relates to a previous guideline issued in 2020 that provided tax relaxation measures to taxpayers due to the global measures taken to prevent the spread of COVID-19. This was covered in a previous webcast, and in brief, it clarified that the period from 21 March to 9 June 2020 should be considered as a frozen period since there was a genuine inability to travel due to the restrictions. The new guideline extends this period for the year 2021 for as long as the restrictions continue to apply globally. Our next development relates to the EU Directive DAC 6, which is expected to be transposed into domestic legislation soon. Due to the fact that some of the deadlines for the submission of the information set out in the directive have expired, a number of extensions have been provided to these deadlines. For more details, you can refer to our tax alert. The Tax Department has recently issued an implementing guideline that overrules the practical guidance followed with regards to the tax treatment of the disposal of a mortgaged immovable property by landowners under the foreclosure procedure. Until today, such disposals were dealt with under the provisions of the capital gains tax law. The guideline states that such disposals should be subject to tax either under the provisions of the income tax law or the capital gains tax, depending on the specific circumstances of each case. In other words, they would look at the budgets of trade to decide if the disposal is of a revenue or of capital nature. Lastly, on the local developments, the Tax Department has published the 10-year government bond yields for the following countries as at 31 of December 2020 for the purpose of calculating the notional interest deduction. We will now have a look at some tax treaty developments. The Cyprus Tax Department has announced that the legal procedures required to bring the amending protocol to the tax treaty between Cyprus and Russia into effect have been completed. The protocol entered into force on the 15th of January 2021 and is effective from 1 January 2021. A circular was also issued clarifying that the new tax treaty between Cyprus and Egypt has entered into force since the relevant procedures required by the law of each country have been completed. The provisions of the new treaty apply as from 1 January 2021. It is noted that the new treaty replaces the old tax treaty, which was signed back in 1993. Let's now move on to some international tax developments. On the 25th of January 2021, members of the European Parliament adopted a resolution pushing for the system used to draw up the EU list of tax havens to be changed. According to this resolution, the old system, despite having a positive impact, has failed to live up to its full potential, as the jurisdictions indicated on the list only cover less than 2% of the worldwide tax revenue losses. Changes to the system were proposed to ensure the process of listing and delisting of jurisdictions to be transparent, consistent, and impartial. Furthermore, EU member states are also to be screened in order to identify possible characteristics of tax havens. It will be interesting to follow these developments and see what they come up with. It is finally worth noting that on the 22nd of February 2021, the EU Council added Dominica to the list of non-cooperative jurisdictions and removed Barbados. We will close off today's tax update with a brief reminder of the upcoming deadlines for March 2021. The 31st of March is the deadline for the electronic submission of the income tax returns for the tax year 2019 for individuals preparing audited financial statements and for companies. This concludes our tax update for this month. Thank you for watching.